Steve Leeson joins us now. With that, I'm worried about commodities again because of China, Steve. So I have some empathy for this viewpoint.
It's an interesting idea, Joe, for sure. But let's focus right now on the gap between the Fed and the market on the outlook for rates. It continues to widen, nearing levels we haven't seen since the summer, raising questions about whether the Fed is going to need to respond by perhaps pushing rates even higher, or if it will ultimately relent. As of yesterday, the Fed funds futures market looked for the overnight rate to end the year around 4.39%. Fed's still projecting a year-end rate of 5.13%, so you can see the gap there, 74 basis points, among the biggest we've seen since the summer when it was 1.14 percentage points, and the market separated the Fed and the market. That led ultimately to Fed Chair Jay Powell's Jackson Hole speech, where he forcefully said that the Fed would be focusing on inflation. He succeeded then in driving rates higher through jawboning, which is a bit what Bullard did yesterday. It worked then, and rates rose. Former Fed Vice Chair Randall Quarles, though, told the exchange yesterday the Fed may have to do more than talk.
The more the markets don't listen to the Fed or don't believe the Fed, then the harder it is for the Fed's policy to have an effect, and it's going to have to possibly increase more than would otherwise be necessary.
Trouble for the Fed here is the market may just push rates lower if the Fed hikes more, with the increasing belief that the Fed is just making a mistake. I want to zoom in on the right-hand part of that chart we just showed you. Markets just about rejected the Fed's new forecast for a 5% funds rate after the December meeting. It reduced rates again with the jobs report Friday and again with the inflation report yesterday. Yet Fed officials speaking this week, they didn't change their outlooks at all for hitting and holding that 5% plus funds rate despite the data. So 3 ways this all works out. First, the Fed turns tail, brings down its forecast. Might be some upside in that trade. Second, the market and the Fed meet somewhere in the middle. Fed, for example, might hike less. The market might reduce its outlook for rate cuts and start believing the Fed's going to hold. Third, and maybe most painful, guys, the market adjusts to the Fed. That could mean an adjustment downward in stock and bond prices, and it's what Bullard was warning about yesterday. Joe?
All right, Steve, I had some, but now I got thrown off, and I don't have anything for you. So I guess we're – oh, no, I know what it was. Steve, that's kind of interesting, that it could be that they're counterproductive, their hikes, because if people are already convinced they've done enough and that more hikes are going to even hurt the economy more, you'd think, oh, my God, they're going to end up cutting rates even more than we thought. So you could end up pushing rates down by continuing to raise rates. That's insane. That could happen.
Yeah. Hey, Joe, I'd like to answer that question. Hey, guys in the back, if you could put up that first chart I used, what we'll see there is it looks like there's a limit to which the market can bring the Fed can bring the market in a place it doesn't want to go. Look right in the middle there where the Fed upped its forecast for 2023 from 3.8 to 4.6. The market was on the way there, and then the Fed did it, and the market adjusted. And then look to the right. The Fed notches up above 5, and the market is just like Kareem Abdul-Jabbar in the center there.
Crazy. Yeah.
And it's like, no, we reject it.
All right, Steve. We're in a rush. But thank you. That is an interesting point where you could actually, be making rates go down.